bird on a tree. I'm just sitting here, I got time, it's clear to see. From up here, the world seems small. We can sit together, it's so beautiful.
This video will take you through the process the auditor follows to complete the subsequent event review. The subsequent event review is carried out at the completion and review stage. Its aim is to identify if events since the year end have an impact on the current financial year and require inclusion in the financial statements. The auditor must identify any post-year events and apply them to the accounting standard IAS 10, events after the reporting period. Carry out audit procedures during the review as per the auditing standard ISO 560. Identify and discuss with management any changes needed to the financial statements, and consider the impact any events identified have on the audit report and opinion. IAS 10 states that there are two types of events that occur after the reporting period. They are either adjusting or non-adjusting. The definition of adjusting events are events that may have been discovered after the year, but where there is evidence that the conditions actually existed at the reporting date. An example would be a receivable customer that has communicated their inability to pay after the year end. It is unlikely that their inability to pay happened overnight. They were unable to pay at the period end, but did not communicate this until after the year end. Therefore, the advice from the standard is to write off the debt as it should be an adjustment in the financial statements. The definition of non-adjusting events are material events where the conditions did not exist at the reporting date, but arose after. They are material enough to feel necessary to inform the users, and so should be disclosed in the financial statements. An example could be a disaster after the year end, like a factory fire. This event would impact on future productivity, and so would be misleading not to inform the users of the financial statements. A disclosure note explaining the event and its impact would be required. The entity should include any subsequent events as per the accounting standard treatment. The auditor must then review any events and their treatment in the financial statements, plus perform other audit procedures to obtain evidence of any further events that may have been missed. They do this with the guidance from their auditing standard ISO 560. ISO 560 subsequent events states that sufficient appropriate evidence must be obtained on events that occur from the year-end date to the date the audit report is signed. During this period, the auditor has an active duty to obtain evidence and identify events which may need adjustment or disclosure in the financial statements. Having an active duty is to perform audit procedures. Examples of typical audit procedures carried out are inspection of post-year-end financial information, for example management accounts. This may identify significant changes to performance that may need to be communicated to the users. Inspection of board minutes of meetings held since the year end. These may identify significant events that may have not been included within the financial statements. The auditor will also review the procedures carried out by the entity when identifying events and preparing the financial statements. It may highlight a risk of subsequent events not being disclosed correctly. This may mean the auditor needs to increase the amount of work on this area. The auditor will obtain a written representation from the directors that events have been disclosed correctly. This acts as backup evidence, and other audit procedures must also be performed. Inquiry with the management of the entity is also likely. The auditors will ask the management if there are any events that have occurred that may need disclosure. Inspecting correspondence, for example with legal parties, may identify significant events affecting the entity. If audit procedures identify events that have not been included correctly or omitted from the financial statements, the next step is to discuss these events with management. The auditor should explain the changes necessary to the financial statements. They should then inspect the financial statements to ensure amendments to the balances or disclosures have been made as discussed. If management refuse to amend the financial statements, there will be a misstatement in the financial statements. If the auditor has concluded that this is material, then this will impact on the audit opinion. If management cannot be persuaded to make the changes, it is likely that the audit report will be modified with a qualified opinion due to a material misstatement. If the event has been disclosed correctly but it relates to a material uncertainty surrounding the client, the auditor may consider modifying the audit report with an emphasis of matter paragraph. Remember that this type of audit report will still state that the financial statements are true and fair, but reference will be made to the event disclosed in the financial statements to highlight its importance. Once the audit report has been signed, it tells us the audit report has a passive duty to identify and react to events discovered. Therefore, once the audit report is signed, the financial statements will be issued and the AGM will be held. During this period, if anything comes to light regarding a material event that should have been, but has not been disclosed in the financial statements, the auditor must take necessary action. Remember, the auditor has no obligation to perform audit procedures during this period. If they become aware of an event at this point, they must first discuss the event with the management and explain the changes needed to the financial statements. They must then perform audit procedures to identify whether the changes have been made correctly. The auditors must then officially withdraw their audit report. Remember, this would have been prepared based on the financial statements before the event was discovered, and so a new audit report needs to be issued to take into consideration the event that's come to light. If the management have made the changes to the financial statements, the auditor will issue a new audit report with the new date signed. They will also modify it with an emphasis of matter paragraph that highlights that the audit report has been reissued. If management refuse to make necessary changes, the audit report should be modified with a qualified opinion due to a material misstatement. This information must be communicated by the auditors to ensure the users are aware of the events not disclosed. I hope you found this video useful. Thank you for watching.